Good evening, everyone, and welcome once again to Case by Case, presented by SmallCase. And this time I am super glad, I am so glad to have the one and only Ambareesh Baliga. Sir, please welcome to the show. Thank you so much for coming. First, sir, before I give you a small introduction, I just wanted to ask, how are you feeling today? And welcome to the show.
Thanks, Avil, for your kind introduction and giving me this opportunity. I'm doing well with God's grace, and hope all of you are keeping fine and keeping safe. Though the second wave actually has taken, most of us by surprise and actually shaken most of us.
Yes. I hope everybody is safe. I wish and hope that all of you are safe. Take care, stay safe, stay indoors, stay at home. And another thing, I was, what I know about Ambareesh Baliga, sir, sir, what I was reading and what I came to know is that you have almost 20 to 25 years of experience. And we were just having a chat right before the call, and you said you've been doing for the last 20 years almost 4 sessions or live sessions per week, which actually blew my mind. And I'm really happy that one of those live shows is with us at SmallCase through the YouTube channel. Thank you so much. And I say this to all the publishers, but I mean it with all my heart. And it might seem like a small thing, but I believe that it's not, because coming on a Saturday or a Sunday, on an evening, to take a session is not easy, because everyone wants to take a break. And when someone takes that initiative to sacrifice that part of their rest or that part of their comfort zone, it really means a lot. I don't think it's appreciated enough. Thank you so much for coming in, sir. I'm handing the control over to you. And I hope you have fun. I hope all the viewers have fun. So, sir will be giving a small introduction about his small case, about his views, and where he's coming from. And after that, we'll be moving into a question and session. Please drop all your questions in the live chat, and we'll try to answer as much of it as possible. Thank you. Thank you so much for coming. The floor is yours, sir.
Thanks, Evan. It's always a pleasure, whether it's a weekday or a weekend, when you have enough number of people listening to you or interacting with you. I think it's, you can always take out time. That's not an issue. And again, it's a pleasure to be here on this show. In fact, I've been in the markets now for about 35 years. To be precise, from the time I was in college in Calcutta in 1983. So, been in the market since then. I did sub-broking for a while. I had some clients of my own around that time. And then started my career with Price Waterhouse, with whom I worked for about 2 years. I then joined the initial team of Kotak in 1991. So spent about 10 years with them. I saw Kotak growing from a small NBFC to an institution. Went across various verticals in Calcutta and Mumbai. And in fact, I was the fund manager for the PMS. And it was, I think, one of the first PMSs under SEBI at that point of time, once SEBI regulations came into play. Then I spent about 10 years with Karvy from 2001 to 2011. I headed the BCG desk, started the research out there, as well as institutional business. The last 7 years, in fact, I've been on my own, advising a few HNI and family offices on the equity portfolio. And I also advise a few small and mid-sized companies on the business strategies. So in fact, I handhold the promoters and act as the sounding board. And this again gives me a view from the other side, which is quite important for an analyst. So without wasting much time, I'll straight away go to the presentation, and I've kept the presentation short so that we have enough time for the Q&A, which is the basic objective of this program. So, in fact, I published my small case last month with portfolio picks which follow my favorite style, which is the Contrarian style of investment. And I branded it as Underdogs Too Will Shine. So these are basically about 7 stocks across 7 sectors. So 50% is in large caps, 25% in the mid caps, and 25% in the small caps. But one thing which is common across all of them is that the quality or the pedigree of the management, and some of them are PSUs. So I've always believed that when a sector or a stock is not doing too well, then check on the management quality and pick the ones which are of the better pedigree, good management, because they will surely take care of the shareholders when things start to look up. So generally, most of these stocks are ignored by the investing public. Either they are not bothered about it because those stocks have not been moving, so there is absolutely no interest in the market, or possibly they have lost money in the past by buying them at a higher price and being stuck. So basically, people have not bothered to look at these stocks or believe nothing will happen. So the way I see for this portfolio is a journey from non-belief to disbelief. Because when they start moving up, one is still unsure whether it will sustain or not. I'm talking from a general investor's perspective. And after they have moved up substantially, then it's a feeling of disbelief. How could this have happened? So in that journey, a huge alpha is built. And typically you outperform the indices number of times by that. So as far as my small case portfolio is concerned, we have already gone through one rebalancing last week after one of the stocks gave spectacular returns in the last 1 month. In fact, it gave nearly 50% plus. And in fact, the returns are a tad bit higher than what is being shown in this graph. It's about 20% plus, because the small case was started on 26th of April, whereas this chart is from 22nd of April. And has beaten the benchmark by nearly 10%. So I would suggest that please log in and check out as to what's happening in the small case. Now, coming to the contrarian investment. Contrarian investment, in fact, is similar to value investing. You typically look for deep value, quoting much below its intrinsic value. And it's just not the price. You don't look at it just because the price is down, it's been down for a long time, or it's not moving. You are basically looking at value, which is a deep discount. The intrinsic value is much, much higher than the price at which it is quoting. And at the same time, contrarian investors should be comfortable holding the stocks which are trading much below the intrinsic value for a much longer time, because the markets may be unfavorable for a while. And even when the markets are good, people are not looking at these stocks. So you really don't know as to when they'll start moving. But finally, the fundamentals have to come into play. So they'll start moving, but the wait could be quite long. So what are the advantages of being a contrarian investor? Like I just said earlier, many times you end up with a multi-bag. So you are actually outperforming the broader indices maybe 2 times or 3 times or maybe more. And the disadvantage of being a contrarian is it is actually psychologically challenging to hold on to an investment when it's not moving. When, again, look at the last 1 year. The markets have played off very well then, but there are a couple of stocks which have just not moved. So you have that FOMO thing playing out. Fear of missing out. I'm holding on to this stock, it's not moving, everything else is moving, everyone else is making money, I'm not making money. So that fear always is there, and people tend to sell out some of those contrarian bets, although they have bought it thinking it is a good buy for long term. But because FOMO starts playing out, you exit that and get into something else. And the most important thing for a contrarian investor, a couple of qualities should have a decent amount of patience and persistence, should be calm, and should be able to tolerate that pain, because that pain can be quite bad. Especially, again, if I take a name of a stock, say for example, ITC. In fact, I'll come to that chart a bit later. If you've been holding ITC for the last 1 year, it's not gone anywhere, whereas the markets have more or less doubled. So you require that tolerance for pain. Should be able to do research, because without doing research, just looking at the price, I don't think one can really last in this market for too long. You need to do at least some amount of research, understand what you're buying. And you should be able to cut the noise, because a number of times you get misled, because, depending on how the markets are doing, the last close to about a year, since the markets have been doing extremely well, there's too much of noise around in the markets. I mean, every day you get so many tips. I mean, even from unwanted sources, you're bombarded with the tips of what to do and what not to do. So, I mean, one should be able to cut out all that noise and have clarity of thought when you're investing. Again, I mean, coming to a couple of these stocks, I mean, on top you can see the chart of Subex. I mean, this company is into security solutions, was doing extremely well in early 2000, 2001 to about 2007, 8. They had huge cash reserves. But then, I mean, having that huge cash reserve, they went in for a much larger acquisition, much larger than Subex itself at that point of time. And they had to borrow for the same. But finally, I mean, that acquisition went wrong. Everything went under. The promoter exited. I mean, the stock came down to single digits. It used to go at about 600, 700 at one point in time. It came down to single digits. Then the new custodians came in. I would say new promoters, but new custodians because they were very well-known professionals in the market. And one of them was Anil Singhvi, who is ex-Ambuja. And they worked to get this company back into the green over the last few quarters. And recently good professionals have joined Subex since then. Now, like I said, the company has got back into green, got the balance sheet restructured, but it was a long wait. Similarly, on mobile. On mobile again was a very sought after company in 2009, 10, 11. And because of a fraud done by the then Indian promoter, I mean, the company went under. The foreign promoter stepped in. But by that time, there was a huge reputational loss in the market. And again, it took them about 10 years to get back on track. The last one on the right-hand side is Himmat Singh Ka Seede. Again, this was a company which was doing very well from 2003 to 2007 when the market was booming. It's into home furnishing and basically exports and the premium range of exports. They had huge amount of cash lying in the books. Investments were large because they had idle cash. So they decided to build a new plant, which clearly is a good idea because it was for expansion, which will help increase the top line for the company, increase the profits. And clearly the demand was good. But again, you don't require cash on day one when you're building a plant. So since there was enough cash lying around, they got into forex derivative instruments about which they didn't have much of an idea. And possibly they were misled. And that ended up in huge losses. Although the new plan started off a bit late, a year or two later than expected. But then by that time, they had to borrow to complete the plan. The plan had teething issues, because of which clearly you've seen the way the stock fell. But then again, it took them another 4 or 5 years to get back on track. So when we talk of contrarian investment, we get into stocks which possibly had done very well at some point of time. I mean, fell on adverse. In fact, these stocks or this company started doing badly in between. And still, we saw that the management is good. Possibly they can turn around. And that is the time you start investing in these stocks. So the wait could be possibly 3 or 4 years, maybe just 1 or 2 years. You never know. But then you should be, able to wait that long. Then again, you have value companies, value investments which you can do. I've just picked up 2 stocks, Hawkins and Aarti. And again, it took a while for the story to play out, but once the story played out, they actually became multi-baggers. And let me again go back to ITC, which I just spoke about some time back. Excellent performance. The only issue is that it manufactures cigarettes. And that comes under the ban list for ESG, which is environmental, social, and governance norms for investing. So number of large funds and large investors who actually follow the ESG norms tend to ignore a stock like this. However good fundamentally it may be. So you look at the, underperformance, especially in the last 1 year. If, like I said, if one had ITC in the portfolio, it's natural to get that fear of missing out. But again, a contrarian in me tells me that everything is actually great about ITC, whether you talk of the management, you talk of the addressable market, you talk of the brand perception, a very healthy balance sheet, and there are no loans, it's full of cash. The only issue is ESG. And if the cigarette business is demerged and mirror equity is allotted to the shareholders, in fact, no one loses. Whereas wealth could get created for the non-cigarette business, which in fact suffers because of the ESG norms, because it's a combined entity right now. So again, hopeful of something like this happening, but we never really know. So I'll just come to some pointers on the market. So here, in fact, I'm giving both the sides. You have a bull case and a bear case. The bulls would say that demand will bounce back as soon as the unlock happens. Like last year, we've seen as soon as unlock happened, there was a huge amount of pent-up demand, and then you had the festive demand. And the cash registers were just ringing for whether it's a white good company or whether it's a discretionary demand company, or whether it is essential goods, or whether it's commodities. You could see demand across. But then this year, I think it would be different. As a bear case scenario, this could be a bit different compared to last year, because the emotional damage is much, much greater as compared to last year, because every other person has experienced the pain of COVID in this wave. At least the last COVID wave was, you were locked up at home, but yes, you used to hear someone got COVID, some friend's friend got COVID. Deaths were much lesser last year. Whereas this time, I think each of us know of someone who's died, a close family or friends. So I believe that people will not really rush to buy white goods or discretionary items because they'll be afraid of the third wave. And then the bull case is the last 3 quarters earnings have surprised, and listed companies have done extremely well, much better than what people could have expected. And that's again one of the reasons for that bull run, other than the sort of liquidity which has been coming in. But again, last 3 quarters very good, basically because of the pent-up demand. You had lower costs because most of the companies had cut costs. And as soon as we had a shutdown post the first wave of COVID, everyone started cutting costs, working from home. So part of those costs will stay low for a much longer time to come, because whenever you cut costs, part of it remains low for a while. And the rest of it, you can't help it. It again gets added back at a later date. And then again, you had the commodity rally. So the companies which were into commodity business really gained because of that. Again, steel is one of them. You've seen that huge steel rally. Or you can see the metals rally. Then one thing we should remember, that what happened last year was a shift of market share from smaller players to the larger ones. And again, most of the smaller players are not listed, whereas the larger ones are listed. So the story which we saw was only one part of the story, which was a positive story in the market. But then, if you're talking of the economy as a whole, it clearly, we had an economy which was shrinking last year as compared to FY19. FY20. FY21, we saw the economy shrinking. So someone has lost and someone has gained. So, and in fact, the losses were higher than the gains, but the gains were seen in the listed players. So all these earnings clearly are before the second wave of COVID, because the restrictions actually started from April. So I think Q1 FY22 is when you'll actually see the real picture. Then the other bull case is we have seen record GST corrections in April. That's fine, but April is March sales. Whatever you sell in March, you pay that GST to the government in April. And that is what gets reported in the first week of May. April, I think this got reported on 1st of May. So the April GST data is something which we'll know in the next couple of days, maybe next 2-3 days, we should know the April GST data. And we should always remember that generally in the whole year, March sales are the best because everyone wants to get as much of sales booking done in March. So the GST payment for March is always the highest. And again, that was pre-second wave. So we will really know as to what happened in April, maybe in the next 2 or 3 days. The other favorite punchline is favorable demographics. We have a huge young population, and this young population will result in huge demand going ahead. True to a large extent, but in a scenario like this, I would say a young population is clearly an asset, no doubt, as long as they are gainfully employed. But in a scenario like this, and going ahead, in case we are not able to really employ them effectively, gainfully, in fact, a young population can become a liability. And again, no one really talks much about it, but it can be a social liability. The other thing which bull case would talk about is a long-term GDP growth. If we could be a double-digit GDP growth country, yes, all that is fine, but long-term, everything works out extremely well. Because as far as India is concerned, whenever we have been into a major issue, economically or otherwise, the Indian businesses have bounced back. But then there is a gap between those bad days and by the time when you bounce back. So what happens in between? We need to think on those terms because, the markets will surely be at much higher levels by possibly 2030. But possibly there can be a huge amount of pain, like what we saw last year over the next couple of months. It'll be very difficult for people to bear it because people have only seen one-way movement. So that's one of the reasons why I would say one needs to be a bit careful because even if you look at the GDP, I think by FY22, by the end of this year, we would have barely touched as to where we were in FY20. And after that, we'll have to see as to how the growth would be. But then I think the next 2 quarters at least would be tough, possibly even the third quarter, because again, some of the states are talking of some sort of restrictions being there. It is still December, and we are yet to see the unlocking of the economy. And the bull case scenario is that a huge number of retail investors have come into the market, and this will sustain the bull run. Yes, I think every bull run peak is made by new investors, and most of these new investors, whom we call Robinhood investors, have actually made good money. And because of which they are putting in more money, and then it's become a virtuous cycle. Because you're making money, you're putting in more money. Because you're putting more money, the market goes up, and the participation of the retail investors has gone up quite a lot. FIs have turned cautious. In fact, it was net selling in May. Mutual fund support has not really been there like what we saw earlier. So they've also somehow turned cautious, and it's only become a retail investors game as of now. But then again, what happens when the market starts correcting for whatever reason? And the reason could be something which we can't even think about right now. But if you look at the history of the market always moves in cycles. And when the market starts correcting, and especially now when we are seeing that the economy may not really perform, the corporates may not even perform like what they've done in the past, the expectations are high. So in that correction, we really don't know as to how these retail investors will behave because they've never lost money. They've only heard about people losing money, but they have never lost money on their own because the last 1 year has been good. They started with a small amount of investment, and now the investment which they have is maybe a couple of times higher than the initial investment because they've been withdrawing from the other asset classes because what you see in the market today is easy money. Wherever you're investing, you're making money, so it's decent, easy money. So when you have made money in the past 1 year, it was on a lower denominator. when you lose money at the peak, it could be on a much higher denominator and the losses could be very high. And at that point of time, you don't know as to how the human psychology will work. And possibly it could result in a panic. So all I would say is one should be extremely cautious at this point of time. Take some money home. I mean, whatever money you've made, at least take a part of that home. And with this, I end my talk, and let's go on to the most important stuff out here. Let's go on to Q&A.
So I think we already have a couple of questions. So I think we'll be flooding in with more questions. So I think we can now.
Yeah, there are a lot of questions which are coming. Yeah. Yeah. So the first question is from Nikhil. Stock prices are overvalued, Nifty 50 and Sensex at all-time high. Can we expect a market crash later in the month of June? Nikhil, again, one can only say that the markets are overvalued, but it's very difficult to say as to when the markets can crack. In fact, I've been saying that the markets are overvalued since the last, I think, 3 months or maybe a bit more. And I've been booking out personally to a large extent, and also been asking my clients to book out. And frankly, I mean, the last 3 months, you look like a fool because you're sitting on cash, not completely because you can never completely exit the markets, but to a decent amount, and the markets are moving up. So I would say it's very difficult to time the market, but I think you should have a strategy in place. That as of now, my strategy is to continue booking out. If one had booked out, say, about 50% as of now, I would say if the markets go up another possibly 4-5%, exit another 10% of your portfolio. So at least you're sitting on a decent amount of cash as and when the markets correct, and they're bound to correct sometime or other. There are quite a few questions on which stocks to buy. That is something which I think I would like to try and avoid. But let me. I think most of the questions are on that. So fine, I'll just answer a few of them. PPCL IOC current level, can I buy at this level? See, PPCL has come out with extremely good results, and they've declared a huge dividend also. If I'm not wrong, it's 58 rupees, 56 or 58 rupees. But the record date is on 2nd. So I suppose you have one more day to buy, which is tomorrow. And even, despite paying this sort of dividend, they still have a decent amount of cash on books. And it's really a divestment candidate. So possibly we can have an upside from there. And what was bogging down the OMCs for a while was because of the election, the petrol and diesel prices were not being raised. But then in the last close to 3 weeks, we have seen a decent amount of increases. So the margin should again be back in place. So I think it's even at these levels seem a decent buy. Anshu Rastogi, is value investing dead? No, value investing can never be dead, but it's quite tough in a market like this because whenever the markets have run up so much, even in the past, whenever the markets have run up so much, and there are so many people looking for good ideas, value buying, then you normally see that like it's a overmind sort of a like a business. So it's very difficult for you to get those value picks at this point of time. But then you should always keep your ears and eyes open. Keep tab on the stocks which you think there is value, or at least there was value sometimes back, but now the prices have gone up. So again, look at them when you have a correction, when you have a decent deep correction. So value investing is always there, but at times it becomes difficult. Dhananjay Kulkarni, please explain investing in international funds are safe. See, you can invest in international funds up to, I think, $250,000, which is allowed per PAN card per year by RBI. So that is the way you can invest in the international funds. But again, since I don't track international funds very closely, very difficult for me to give you much of an idea on that. But then it gives you that diversification, both currency-wise as well as stock-wise, and as well as geographical-wise, I would say. It gives you that diversification. So I think a part of your portfolio should be in international funds, which unfortunately we could do possibly 10, 15 years back, but now there are a lot of opportunities. Yash Kunshi, which type of companies create more shareholder value for continuing existing investors? Companies doing regular buybacks, or companies which can raise funds at high valuation, low cost? See, I don't think there's too much of a connection between companies doing buyback or the companies which can raise funds at high valuation when it comes to creating wealth for shareholders. Because companies doing buybacks, if there's decent amount of cash flows happening, the business is doing extremely well, the business is growing. But for the time being, they don't have worthwhile areas to invest their money into. So they normally do this buyback. And I mean, especially if the valuation keeps moving up and you have not participated in the buyback and you continue to be a shareholder, then surely you'll be a gainer. Because as the valuations move up, the last buybacks looks extremely cheap. And by doing that buyback, the company has reduced the number of equity shares, which actually means that you would gain because the lower number of equity shares in the market, I mean, like your valuation goes up. But again, the question is that the company should continue to be growing. And as far as companies which are able to raise funds at high valuation and low cost, yes, it's extremely good, but they should be able to utilize that money gainfully. I mean, just to give you an idea of the stock which I spoke about sometime back, Subex. Subex raised huge amount of FCCBs at, I mean, when the stock was quoting at about 600 odd. But finally, the conversion actually happened when the stock had come down to about 20, 24 levels. Because the place where they used the money, it all went bust. So the price came down to about 11 rupees or even lower. In fact, it was quoting in those single digits. But these FCCBs got converted in that 11, 14, 24 range. And because of which the equity capital really bloated. So, and like that's the reason it took them so many years to sell the balance sheet, right? Yuvraj Bharadwaj, is investing in small case better or as SIP in MFs? See, small case or MF, very difficult to compare because small cases are more of sort of saturated portfolios, theme-based. So what I would say is, again, like what I said about the international funds, this is a good diversification for your portfolio. So have something in small cases, have something in MFs. You really can't replace one with the other. Raju S. Are the markets saturated? Can they rise further, or is it time to look for opportunities in small caps? See, Raju, like I said, the markets look saturated, but nonetheless, it can move up further. And now the stocks which are flying are more of the small and mid caps. Again, I mean, if you're a short-term player, if you're a trader, yes, I think you can try your hand at small caps, but just remember, I mean, keep a very, very tight stop loss, because when you're a trader, or even as an investor, I mean, discipline is most important, and more so for a trader to keep a stop loss. Most of the traders lose money because they don't have this discipline of keeping a stop loss. When you're in profit, you book your profit. When you're in loss, you hold on, and then you become a long-term investor. Don't do that. A number of other questions are there, which are again asking whether the bear market is nearer by with Malu. Like I've answered that earlier also. Digvijay Singh Samyal, how long are the metal stocks expected to grow further, or should we exit now? See, the way I see it is the metal rally, again, mostly the steel rally happened basically because one, there was a huge increase in infrastructure projects across the globe because of COVID, because that's the best way of getting the economy back on track. So most of the government started spending on infrastructure. So automatically the demand for steel moved up. But it didn't move up so much that the prices had to really shoot through the roof. What happened was China, which has close to about 50% capacity of steel globally, started shutting down a number of non-compliant plants, and because of pollution control also. And that created that scarcity in the market. And as soon as that happened, the steel prices really shot up. And along with that, anyway, the demand was growing. But then I don't see this as a natural phenomenon. It would have been a natural phenomenon if the steel prices had gone up only because of demand growth, which was sustainable. But then here it went up because of China's action. And a country like China, I think one should be very, very cautious of the sort of policies which they come out with, because they can change things overnight. Because I'll not be surprised if they come back and say that, okay, we are allowing a couple of these steel companies to start production. Again, the thought process behind that would be that the steel prices have gone up so high, let's utilize it. At the same time, the companies which have been shut in the last couple of months, they'll again come back on track with more efficient machinery to start steel production. So I really don't think, because basically they were closed because of the furnaces, and they were supposed to come out with more efficient furnaces. So that can happen sooner than later. So I really don't think that the steel rally can continue much longer, although people have been talking of a super cycle in steel, but I doubt. And I would suggest that it could be a good time to possibly book out, at least to a certain extent, if not completely. I think most of the questions are on similar lines. Siddharth Jain, it's something different. When do you think this e-commerce bubble will burst? I don't think the e-commerce bubble can burst. I mean, e-commerce is there to stay, but surely you'll have a number of companies in e-commerce going bust. But e-commerce as such, I think is there to stay because that's the future. Arvind S. Investing in pharma stocks is good now, or is it too late to invest now? So pharma stocks, I think, is one of those sectors which will continue to move up. When I say continue to move up, if the market cracks tomorrow, surely you'll have the pharma stocks also correcting, but they will correct lesser than what the markets would. So I would say it will outperform the markets. And the other thing which not many people have been talking about, although the sentiment has been positive in pharma because of COVID, although there are not too many companies in India which are, or at least there are not too many listed companies in India which are manufacturing vaccines, only a handful of them. So not all the pharma companies are going to benefit out of it, nor are there too many companies which are in COVID related medicines. But the way I see going ahead is that COVID patients, unfortunately, will be suffering. That's what I hear from some people in the medical fraternity, although I'm not an expert in that. This is what I've been hearing, is that the issues will continue for much longer. And although they would have survived COVID, come back healthy, but the problems will persist for much longer time. And ironically, this could be a huge opportunity for the pharma sector. So I think pharma overall over the next 10 years certainly looks good. Zani, is it right time to invest? RBI has cautioned us, saying it's a bubble. Yes, again, I've also been talking of the same thing for a while, but always remember that bubble can grow bigger before it bursts, and that time which it takes to get bigger, you never know. You really can't time it. There are a few questions on Sharia compliant small cases. Again, I may not be the right person to answer that, so I will possibly skip it. Small case for 10 years long-term investment. Again, that depends on a specific small case as to what is the timeline given by the publisher. If the publisher continues with that small case for 10 years, yes, it becomes a 10-year investment because they would keep rebalancing it. So I think it will depend from the publisher to publisher. So again, most of the questions are on the same lines. It's all about steel. Okay, one more question is there on FMCG companies. Jitendra Kumar has asked my take on FMCG companies. So FMCG companies, I think, will continue doing well, even post second wave, because most of the FMCG companies are where you're buying your daily needs. And again, when I talk of discretionary, I think the demand will still be decently good for the small value discretionary. Whereas when I say small value, I would say possibly someone buying a fan or someone buying a slightly more expensive food item. I think the demand would be there for those. But when it comes to discretionary like buying a two-wheeler, buying a car, I think the larger value discretionary, I think that will suffer. Whereas low value discretionary, I think will still continue to sell. Vikas Kumar has asked about rebalancing time of a small case. So again, that depends from publisher to publisher. Although I had mentioned in my case, I had said that I will rebalance every quarter, but then I ended up rebalancing within a month because one of the stocks really shot up, and I thought it was time to possibly book out and get a new stock in. Yeah, one has Chandrasekhar J. Stay invested in Bharti Airtel is a good option since 5G is upcoming growth. Yes, surely I think telecom space overall I think is a good option because that's one sector where the demand can never fall, whether it's COVID or non-COVID. Because typically I've been saying that in the past also, because the necessity things which we have is air, water, food. But I suppose you have to add telecom to that because that could be third or fourth in the priority list. So telecom is a must. And the sort of ARPUs which our telecom companies are getting right now is among the lowest in the world. And I clearly see the ARPUs moving up. Bharti has already said that they're looking at ARPUs going up to 200 over the next couple of months and possibly 300 over the next 1.5 years, 1.5 years. And I doubt whether this would really hurt anyone paying 100 rupees more per month, because most of the time you're spending time on your phone or on your computer, accessing the net or on social media. So you won't mind paying 100 rupees more for the benefits which you're getting from all this. So I think once the ARPUs move up, so ARPUs moving up 100 means a huge flow for the telecom companies without much of an expenditure. Because whether ARPU is 150 or whether ARPU is 250, your cost is the same for the telecom company. So most of the money which comes in really gets added to your bottom line. And just imagine, I mean, there are about, if I'm not wrong, 110 crore connections, 110 or 115 crore connections. And if you're getting 1,200 rupees more per connection every year, just calculate and see as to how many zeros. Abhishek Bhanushali, which sectors do you see a downfall in upcoming months? So the sectors which I see possibly coming down are clearly the commodity sector, which has anyway shot up to high, especially in the metals. I also see the auto space possibly not doing too well in the coming months. Whereas the space which I see continuing to do well would be FMCG to a certain extent. Specialty chemicals, basically because of the China plus one, which is working out decently well in terms of Indian specialty chemicals companies. So these are the ones, including pharma, which I said. Okay. There's one view of Praj Industries by Tushar Rajola. So Praj is one company which I have been recommending on and off. My initial recommendation was about 20 years back when no one had really heard of Praj. And it was a value pick in 2002. It was quoting at 5 rupees. And from there, I saw a 400x sort of a return. It went to 2000 by, I think, 2007. And at that point of time, we had given a good profit, saying that whatever story we had as far as the fuel ethanol was concerned, that story has played out extremely well. And more or less, whatever capacity creation was required has been done. So, we will not get fresh orders for Praj after that. And that's the way it played out. So, from 2007 to 2017, 10 years, the stock rate didn't go anywhere. It was a sort of range bound underperforming. And then again, I came back in 2017 and said that the next phase of growth should start now. We had the first generation ethanol plants in the last decade. The second generation plants, which were introduced by Praj, should really see fresh orders coming in. And because the mixing of ethanol and petrol is moving up from 5% to about 20% over a period of time, this company should really get those continuous orders for much longer, because 5 to 20% would mean nearly 4 times the capacity requirement. And then there were other changes which were made in the sugar industry. Like earlier, you could make ethanol only if you're making sugar. But as per the latest regulations which came about a year and a half back, you can make ethanol directly from sugarcane. You not even make sugar. So that was a big booster for sugar companies to actually put up ethanol capacities. And because of which, again, I started recommending Praj. But the way the stock moved up in the last 3 months, I mean, it nearly became close to 3x in 3 months. I felt it was a bit overdone, because of which I said possibly it's a good time to book out to a certain extent. Although the longer term story remains, but in short term, it's been overdone. So let it cool off and then maybe you can buy it back again. So I'm still positive in the longer run, not too positive in the short term. Short term again. So I think that's more or less done, because most of the other questions are on similar lines.
I think most of the questions that are coming in are on similar lines. We can perhaps, I think we still have maybe just 5 minutes on the clock. So I think we can stop the question session. What do you think, Ambareesh? Do you want to keep going with a few more questions, or shall we stop? What would you like to do?
No,
I think we have a few more questions coming in. I think we can take the last couple of 2 to 3 more questions, and then we can.
Okay, there's one question on Reliance Power. I think this was the best marketed IPO. I think before the last bust which happened, just before that Lehman Brothers issue happened. And I remember that if you are not applying for Reliance Power IPO at that time, then there's something wrong with you. I mean, that is how we are made to feel. And I don't think this stock ever saw those IPO rate after that. And it actually came down to the single digits. But the last quarter results show that there are some green shoots. The company has turned profitable. So possibly if you are looking at Reliance Power, I mean, again, let me tell you that I've not done a very in-depth study on this. I'm just saying overall. The only issue out here could be that the rest of the group is not doing well. And I think all of you are aware of that. And typically what happens when one company in the group is performing and the rest of the companies are in trouble, they are starved for cash, there can always be some movement from the company which is generating cash to the companies which require cash. So because of which the company which is doing well also is not really able to perform. So just keep that in mind. Otherwise, I think at these levels, if you want to take a punt, one can. Let me say it's a punt. That's it, yeah.
All right. Thank you so much, Ambareesh. I understand it was a long session with a lot of long questions. But thank you for all this, to the audience as well for a lot of insightful questions. And, Ambareesh, thanks for taking the time to actually, giving out these answers. So one thing that I'd like to, tell our viewers is that let's try not to spam the chat with a lot of the same questions and again and again. Well, this is, we recommend this because we understand the question is valuable and we've recorded it. But this is because other people wouldn't get a chance to put in their questions as well. So let's try to refrain ourselves from spamming the chat account so that everybody gets a chance, so that they can ask their questions. And Amrish, I just wanted to put it out there, but how was your experience with today's AMA, and how was your total experience today? The questions, the answers, and
In fact, the experiences have been really good. And what I see making a difference between the investors, the retail investors, about 10, 15 years back and now, is that currently I think people are reading up decently well. They are more knowledgeable than what I've seen as far as retail investors are concerned, what 10, 15 years back. So that's a very welcome change.
Got it. So I think that's also like I saw one of the questions that said, will the e-commerce bubble burst? Or you said that
absolutely,
it's here to stay. So I also believe that the e-commerce space has helped people to be better investors, to make it more accessible to the current community or the current generation, because it helps us to invest better through apps or through SmallCase to make investing much more easier. So thank you so much for, again, I can't stress enough for actually coming on a Sunday evening, because I really do understand. And before we go and before we end the call, I just wanted to ask you, what would be that one advice that you would give for an upcoming or a growing or a budding retail investor or any investor in general? With your 25 years of experience, your insights, what is that one advice that you would give?
So there are a couple of things which I've also discussed a bit in this chat. I mean, very important to do your own homework. Don't really expect a free lunch in this investing business, because you'll keep getting a lot of tips. A lot of people tell you what to buy, when to buy, but no one's going to tell you when to exit. So you have to do your own homework and only buy when you're convinced. Don't really buy on tips. And at the same time, like I said, try and cut out as much noise as possible, because again, noise as it is disturbing. So try not to get information from as many places as possible. I mean, if you're doing your own research, then you don't really require that much of unwanted information. And it is very important, very, very important to maintain discipline. Never really stray from your focus. And at the same time, just ensure that you're not really getting over-invested. However confident you are, I mean, there has to be some limit to your investment. Don't put all your eggs in the same basket, however confident you are. So these are a couple of those things which I've learned over the period of time that I applied.
Thank you so much. I think these are the tips that a very let's say a disciplined investor has to follow, much like yourself. Thank you so much again. Once again, I can't stress enough for coming in and taking the time. We hope to see you again and collaborate more often.
Sure.
Thank you so much, and thank you, viewers. And tune in again to another case by case to see more webinars. Please subscribe, and you can also view Ambareesh Baliga's small cases, which are linked below in the description box. Thank you once again, and have a great Sunday.